Today we are going to take a quick look at 3 companies that I really like. They have certain characteristics that I'm looking for. They have a potential to grow our wealth while at the same time the risk is acceptable. Of course, we are all different. We are at different points in our financial journey and we have different goals. But the 3 stocks I'm going to talk about today are such great companies that they probably could be a part of almost any stock portfolio. Okay, let's start with Texas Pacific Land Corporation, ticker symbol TPL. They own land in Texas and they lease it to other companies and organizations, so their costs are super low. They get royalties from oil and gas and water production, which takes place on their land. That is one simple business. So let's look at the fundamentals. Return on invested capital, 87.2%. That is just crazy. But that's not all. Net profit margin, 62.8%. And finally, years to pay debt, 0. So we have a company that has absolutely incredible return on invested capital, that has beautiful margins because the costs are so low, and they have no debt. And what about growth? Well, when we look at revenue, we see a 30.5% 10-year compound annual growth rate. When we look at free cash flow, that is 29.5%, and earnings per share, 32.5%. So such growth is absolutely incredible. And it also pays dividends. The dividend yield is 0.3% and the payout ratio is 24.6%. So it's a small dividend, but it's just basically a cherry on top. And when we look at the valuation, we see that Texas Pacific Land Corporation has a PE ratio of 65.6. That is absurd. But the average historical PE ratio of Texas Pacific Land Corporation for the last 10 years is 33.2. So they are always trading at a premium. And this stock was much cheaper not that long ago. In just 1 year, it went up by 148%. Even in my last video about it, I said that it is somewhere close to fair value. The price was around $600. Now it is around $1,300. So currently it is rather expensive, but it's such a beautiful, simple business with incredible margins that if at any moment the price drops closer to the fair value, I will be there to pull the trigger. Next company I really like is Ulta Beauty, ticker symbol ULTA. It is another straightforward business. This company is the largest beauty retailer in the United States. This time we have a company with a PE ratio of just 14.5. That looks very promising. And looking at my valuation in the stock ranking, it seems that it is overvalued, but really not by much. So there are a number of things to like about Ulta Beauty. First, the financial health looks really strong. Return on invested capital is at 28.3% over the 10-year period. That is magnificent. Net profit margin is averaging 9.5% over 5 years, while the sector median is only 4.4%. So Ulta Beauty is using its scale very wisely to generate profits. And what about debt? That is actually a big check mark for them. They can pay their debt in a matter of months with their current free cash flow. And we only see short-term debt without any long-term debt at all. But financial health is just one part of what makes this company attractive. When we look at growth, the numbers are even more impressive. Revenue growth, 15.4% 10-year compound annual growth rate. Free cash flow growth, 26.2%. That is very impressive. Earnings per share growth, 23.5%. What's really great about this is that all this growth is organic. They don't use debt to grow, and they don't issue new shares to finance it. This creates a great safety net because they have impressive growth, but they are not pushing it too much or artificially accelerate it. This approach significantly lowers the risk of something going terribly wrong. They are being smart about their expansion, opening new stores and entering other markets like Mexico, but doing it all with their own cash flow. That's a sustainable business model I really appreciate. And finally, we get to the third company on this list. And it is Visa, ticker symbol V. Visa is one of the best companies in the world. They have a duopoly with MasterCard, but I prefer Visa because it is a bit cheaper right now, though its PE ratio of 35.2 is still pretty high. But in the current inflated market, we shouldn't expect anything else for such a great company. Let's look at the fundamentals. Visa has an impressive return on invested capital of 21.4% over 10-year period, showing that management is doing a really nice job. What really stands out is the net profit margin, averaging 51.9% over 5 years, while the sector median is just 22%. In fact, Visa has the highest margin in the entire industry. What about debt? Also a check. It would take just less than a year to pay off their debt with a current free cash flow. When we look at growth, Visa doesn't disappoint. Revenue growth is at 11% 10-year compound annual growth rate. Free cash flow growth is at 10.9%, and earnings per share growth is at 16.2%, which is so high partly due to their share repurchase program. While the dividend yield is modest at 0.6%, the payout ratio is a healthy 21.4%. Those numbers are just great. And I really like Visa not only because it has a great moat and a duopoly with MasterCard that is working beautifully for both of them, but also because it is just a great business all around. How often do you find a company with over 50% net profit margins? That's the kind of exceptional business that deserves a premium valuation. And you may argue that companies that are growing faster will be better investments, and that may be true. But those three companies give you other things. They are relatively safe. They are strong businesses with a lot of potential in the long term, and they are simple to understand. I am a big fan of Warren Buffett's saying that the first rule of investing is never lose money, and the second rule is don't forget the first rule. Those companies may be boring and old, but they can also grow your wealth with a rather low risk of going bankrupt. If you would like to learn more about any of those great businesses, then check out my analysis. Thanks for watching and see you in the next one.